Hello YouTubers, Alaska Prepper here. I wanted to do a quick video on explaining to you all how I understand the fractional reserve banking system and how I understand that it works. Now, I'm not an expert at this. If any of you out there are experts, let me tell you what, ladies and gentlemen, if there's someone out there that works in the banking system, someone that's listening, that works in the banking system, that understands exactly how this works, if you could please volunteer to do an interview with me, that would be awesome. But this is how I see it, and this is how I see it for the scam that it is. And as I explain, you'll understand why I think it's a scam. So what you're looking at here is supposedly the American dream to, get through the education system, however high you may want to go, buy yourself a nice home and live a comfortable and hopefully peaceful life. All right, that's the American dream. Be able to raise your children with the values that you see that are important instilled in your children, and to get your piece of the American pie. All right, and when most people look at getting their piece of the American pie, the first thing they think about is, yes, I want to own my own home, even though you never really own your own home, and that would be a different topic for a different video. But let's just say own your own home for this instance. Okay, so let me explain to you how I think this happens. You go to a bank, you go and find a home that you like, and this home here looks very nice. You're very nice, average middle class American home. Okay, you say, wow, that's a really nice house, I would really like that for my family, and I'm gonna go and see if I can get it. So you go to a bank and you say, hey, I want to buy this home, and the bank checks your credit and all that kind of stuff, which is another scam in itself, the credit system. But like I said, that's also another topic for a different video. And they're like, okay, yes, you qualify to buy this home, and I want to say that you put 10% down, which normally you have to put something down. Nowadays, you could probably buy a home without putting anything down. But let's say that you put 10% down, okay? And then the bank cuts a check. Let's say this is a $300,000 house, right? The average value of a home in the U.S., and I'm talking really about the around 2008 time frame, okay? Because that was the last really big bubble, except for now. Now the bubbles, I believe, in the housing market are somewhat localized, meaning that there's different areas within the country where housing is by far way more expensive than other areas. All right, but let's say that the average price of a home, it's around $300,000. You go to the bank, you give them 10% down, they cut you a check for the remainder of the balance after you put your down payment on, and then they take that check and they give it through escrow to whoever sold you the home. Okay, and obviously through escrow, the check might be split up into 2 or 3 different pieces depending on who are lien holders of that home, etc. Okay, but you give them the 10%, they cut you a check, and they go ahead and give the check to whoever it is that you're buying the home from. Okay, so what's the problem with that? Okay, well, the problem with that is this, is that 90% of the value of that home that you're borrowing, that 90% of the $300,000, or let's say $270,000 that you're borrowing, if you were lucky enough to have had saved, or not lucky enough, disciplined enough to have had saved, the 10%, to put down on this home. That $270,000 that they just cut a check for, it doesn't exist. It came into existence the minute that the manager of that bank or brokerage or mortgage company or whatever you want to call it signed the check. Once that financial instrument, i.e. the check, once it was signed by the person in charge, the person that's in charge, I don't know what the names are and stuff like that, you know, internally, but the person that's in charge of signing the checks and obligating that institution to, you know, to the funds that they're paying out, that money was just created in that instance. Okay, of course it probably takes a few computer clicks here and there, but that money was just created out of thin air, and I'm going to show you how. All right, I'm not just saying this, I'm going to show you how that money was created out of thin air. All right, so like I said, you walk into a bank, you get a loan for a house, you get your loan, and now not only do you get to pay back the principal that you borrowed on that house, the $270,000 that you borrowed, not only do you get to pay that back over 10, 15, 20, 30, I think I heard somewhere that there's even 40-year mortgages now. Okay, so 10, 15, 20, 30, 40-year mortgages. All right, not only do you get to pay that principal back over that amount of time, but you get to pay back interest on the money that you borrowed. All right, and depending on the interest rate would depend on how much you pay back. Depending on the interest rate and the length of the loan would depend on how much interest you're going to pay back on top of the principal. And normally, if you get an average interest rate of about, now they're going for about 5%, 5.5% roughly is what they're going for now, you're going to easily pay more in interest than what you paid for the house. All right, so your interest is going to outpace the amount of principal that you pay, meaning that you pretty much purchased that house for twice as much as what it was worth when you purchased it, okay, and what it was valued. So when you go and look at a house and you're going to buy a house, and that house is going to be $200,000, and you're taking out a loan, you can pretty much tell yourself, I am going to be paying $450,000 for this house, because that is what you're going to pay for it. So now what happens if you fall behind on your payments? What happens if you come into hard times? All right, depending on the severity of your status, the bank can decide to foreclose on your home. So let's say you paid on this house for 10 years. Let's say this house is $300,000 over 30 years at about 5.5% interest. I'm just guessing here, very rough estimate. $300,000 for 30 years, you're looking at $10,000 a year roughly. I mean not $10,000 a year. Let's see. Yes, roughly $10,000 a year in principal that you'll have to pay back. You know, and I know I'm splitting it up evenly. I know that normally in the beginning you pay a lot more interest than principal, and then the principal catches up, etc. I understand all this, but I'm really simplifying it. So let's say you're paying about $10,000 a year, and that's just principal roughly. So let's say you're paying back around $20,000 a year roughly. So you're going to be making a payment of about $1,500, $1,600 a month, which sounds about right. $300,000 or $270 at about 5.5% interest. You're looking at about $1,500, $1,600 a month roughly. Okay, I might be off by a few dollars, but just roughly. Okay, so let's say you're paying, you know, $18,000, $19,000 a year. All right, and you've paid on this house for, let's say, 15 years. So 15 times 2,000 is 300,000. So you've probably, you know, at $1,800, $1,900 a month, or 17, whatever, you know, in that area, in about 15 years you will probably have had paid that house off, if you include the principal that you paid and the interest that you paid. All right, so it would probably take you about 15 years to pay $300,000 on that house. Then the other 15 years that you're paying is pretty much, you're just paying, is pretty much interest. So half of your loan is pretty much going to pay the house, and the other half is pretty much going to pay interest. So let's say after 15 years or so you fall on hard times and they foreclose on you. You'd already paid the bank back every single penny you borrowed, with the exception of interest. Okay, so now the bank gets to take that house from you. And this is the main point. The bank created the money that they loaned you out of thin air, literally out of thin air. All it took was a few clicks of a keypad and a signature of a check, or even maybe even a digital signature on a document. And they created that money out of thin air, okay, through fractional reserve banking. Okay, I think it's a lot worse now than fractional reserve banking, but I'm using fractional reserve banking because that's supposedly the model under which banks operate nowadays. Okay, so, and by just letting you know, fractional reserve banking means that a bank is supposed to have at least 10% of all deposits, you know, on hand. All right, so if you deposit $1,000 into a bank, they have to keep at least $100 in reserve, in liquidity, and they can loan out $900 of that $1,000 that you deposited. All right, so that's fractional reserve banking. All right, so like I said, they can come back and take your house. They can take something that has real value, right? They can take something that has that is tangible, that has real value, that you can touch, that you can feel. All right, like a house. All right, because a house is something that has real value. It provides shelter, it provides warmth, it provides security. Right, all of the things that a house is meant to do, a house provides. It has tangible value. But the point is that after a few years, a bank can come back and take it from you, even though that the money they loaned you never existed. All right, so this is the big scheme. All right, this is the big deal about what fractional reserve banking does. And I want to show you. So I've always had a theory that the biggest real estate holder in the country, and I don't know this to be a fact, but it's, like I said, it's a theory. To me, when people ask you who's the biggest real estate holder in the United States, some people may say, oh, Warren Buffett or Ted Turner, who's a billionaire, or this guy or that guy or this guy, right? I don't think it is. I don't think they are. I think that the biggest real estate owner in the United States is the Federal Reserve Bank. And I'm going to show you why. But first of all, I want to go ahead and walk you through a little bit of how fractional reserve banking works. Let me see if I put my slides in order here. Okay. Okay, so this is what fractional reserve banking is. How much money can a bank lend? If the reserve requirement is 10%, for example, a bank that receives a $100 deposit may lend $90 out of that deposit. But here's where the money out of creating money out of thin air comes from. If the borrower then writes a check, the person is receiving a loan for $270,000, right? The bank takes that check that they wrote. First of all, they wrote that check and it came out of thin air because the borrower had a 10% down payment, right? So that $270,000 came out of thin air. If they take that $270,000 and they deposit it into the seller's bank account, now the bank that the seller has that money in, now they can go ahead and they can lend out 90% of that $270,000 that was deposited, and so on and so on and so on, and it goes down the line, and it takes a long time for it to zero out. Okay, so that's how fractional reserve banking works. Okay, now back in 2008, all right, if you read here, since the financial crisis began since September 2008, all right, and this is 3 years ago. It's a lot more than that now. Okay, this is 3 years ago. It's a lot more than that now. So about 5.5 million homes have been lost to foreclosures across the country. Okay, so between 2008 and 2015, 5.5 million homes have been lost to foreclosures across the country. Okay, so 5.5 million families were forced to move out of a home that they paid for whatever amount of time they paid for it, from a loan that a bank gave them, where they made that money out of thin air. All right, so depending on how much time the family paid into that home, right, paid for it for 5 years, 10 years, 15 years, 20 years, whatever it was, the key point here is that the bank is taking something away from them that the bank acquired, all right, by printing money out of thin air, by loaning out money that they did not have. Okay, and I'm going to show you how it is that they did not have this money, all right, for those of you that may be skeptical of where I'm getting at here. And now let me go ahead and deliver you guys a side note. Some people are going to say, all right, or think, well, if someone could not have afforded to borrow the money, then they shouldn't have borrowed the money, and they should have been responsible enough to pay their bills. Well, that goes one of two ways, okay? There's a lot of propaganda out there. Just go back to the commercials that were going on during that time, 2006-07. President Bush during that time telling everyone, hey, go out and spend money. Go to Disney World. You know, just spend, spend, spend. And all of the programs that the government was subsidizing to get people into homes that the people themselves could not afford. All right, all of the programs that banks had, right, that were kind of like predatory programs, where they loan money to people that they knew would not be able to hold on to this loan for long term, just so that they can make that sale. Okay, so think about that as well before we get to, you know, well, people shouldn't have borrowed this or that. Okay, because it is the American dream to own your own home, right? That's the line that's been pushed down our throats for generations, for more than a generation, for generations. Okay, so that gets into people's psyche, and for some people, after all of the propaganda that's been shoved down their throat, all right, they really believe that. Okay, and they will do anything they can do to get their family a home, even though in some instances it is better to rent for a while and save up to get something that you can afford and get something that you can keep up with paying. Okay, so like I said, so let's put that at about 6 million, or we'll leave it at 5.5 million. Okay, so there was about 5.5 million foreclosures, all right, between 2008 and 2015. All right, so currently the Federal Reserve holds about $1.74 trillion worth of mortgage-backed securities. And what are mortgage-backed securities? Mortgage-backed securities are just pieces of paper that say that the Federal Reserve owns this house. All right, because they own the deed or the lien. They have the lien or they own the deed on this home because they purchased that security from a bank that foreclosed on someone who couldn't pay their mortgage. Okay, so what they did was the Federal Reserve pretty much made the banks whole. So they allowed the banks to take the houses back from the people. They paid the banks what the banks were owed for those homes, and now the Federal Reserve pretty much owns those mortgages. Okay, so they pretty much own the house, if you want to put it that way. Okay, so right now they hold, and this was as of this year, okay, right now they hold about $1.74 trillion worth of mortgage-backed securities. Okay, all right, so around 2008, all right, the average home was selling for roughly $292,000. All right, so we'll call it $300,000. Right, the average home was selling for. And I know that the average price of a home goes up and down through the years, but we'll use around $300,000 just to keep it nice and simple. Okay, so this is why I say that the Federal Reserve, in my opinion, is the biggest holder of real estate, or the biggest owner of real estate in the U.S. Okay, because check this out. $1.74 trillion in mortgage-backed securities. Average home is around $300,000. If you take $1.74 trillion and you divide it by $300,000, you come up with 5.8 million, or 5,800,000. How many people lost their home? How many foreclosures were there between 2008 and 2015? And like I said, ladies and gentlemen, my numbers may be a little bit off because I'm using a little bit of a time gap here, but I'm just trying to put the idea in your head of how it is that this works. Okay, so we have about 5.5 million people that lost their homes, right? It's about the same amount of the average home in relation, sorry about that, my heater, ladies and gentlemen, in relation to the amount of mortgage-backed securities that the Federal Reserve owns. Right? Now, I'm sure that the amount of people that have lost their homes between 2008 and the time that this article here, this one here was written, all right, I'm sure it's more than 5.5 million. So even if you put it at 6 million, it's still pretty darn close to the number of homes that you would get if you divided the amount of mortgage-backed securities that the Federal Reserve has by the average price of a home, give or take a few $1,000s. So that's what I wanted to get at, ladies and gentlemen. It's a huge scam, all right? These banks right here, especially the Federal Reserve, and when I say banks, is the entire banking system in the United States, they're all connected to the Federal Reserve, okay? So whether Jimmy John here deposits $100 in this bank, and then Jane deposits $100 in that other bank, they're all using the same motherboard, if you want to put it that way. They're all using the same motherboard. So that's, to me, it's ingenious how these people came up with it. Not ingenious in a good way, but it's ingenious how these people came up with a system by which they can fleece the country. I'm not even talking about just individuals, but how they can fleece the country and pretty much steal their land. Steal the land here in the United States in a legal manner. Now remember that legal and lawful are two different things. Alright? But they're doing this in a legal manner. They're pretty much stealing the earth from underneath our feet in a legal manner, little by little. Okay? Now I want to show you how the fractional reserve system works. So I did this little spreadsheet. Okay, so I've got $1,000 that I deposited into Bank A. All right. So once I deposit that $1,000 into Bank A, that bank keeps $100 of that $1,000 in reserves, and then they can lend out $900. And that $900 that they lend out, eventually that $900 will end up in the banking system one way or another. Because even if I go into a bank and I say, yeah, I want to borrow $900, and they give me $900 cash, and I go spend it here and spend it there and spend it there, eventually it's going to find its way back into the banking system, because people deposit the cash back into the bank, and then they pay their bills with it here and there, and then they deposit that cash into the bank, etc. It just keeps going. Okay, so that's actually called velocity of money. However, once that $900 ends up being deposited in a bank or banks, that bank or combination of banks in which that $900 was deposited has to keep at least $90 in reserves, and then they can lend out $810. Okay, and then it just keeps going. And then when this $810 gets deposited into a bank or a combination of banks, that bank or banks has to keep at least $8,100 in reserve. $81 in reserve, and then they can lend out $729 in reserve, and it keeps going and going. So $1,000, all right, by the time that $1,000 that we started with is actually in the banks, is actually in the system as physical cash, as real money that was put in there, or real currency that was put in there. Check this out. It takes roughly 70 to 75 transactions for that $1,000 that we started with to actually end up in the bank. But by the time that $1,000 is actually in the bank, the 1,000 that we started with, 9,000 has been loaned out. All right, 9,000. Now, this doesn't sound like that much money, right? But ladies and gentlemen, use a billion instead of 1,000. Okay, use a billion instead of 1,000. That's pretty scary. All right, that's how banks get their money out of thin air. All this money right here, this $8,995, was created from $1,000. Okay, so think about that. $9,000 was created from $1,000. That's how banks get their money. All right, I think that it's much worse than that right now. I don't even think that banks are required anymore to have a 10% holding in their bank. I don't even think they're required to do that anymore, because if you go to a bank and you ask them to give you $10,000 in cash, it's going to be a really big hassle for you. Okay, most banks don't even have that much cash in their vaults nowadays. Okay, so I think it's even worse than that. All right, but this is how money right here, this is one way that money is created out of thin air. All right, purely out of thin air. So you are being loaned money that's created out of thin air, and then after you've paid most of that money back, including interest, if you fall on hard times, the same people that created that money out of thin air get to take away your asset and all of the years investment that you had invested in it from working to earn money to pay that loan back. So you're paying back a loan that never existed until you asked for it. That's how this system works, ladies and gentlemen. It was not developed for you and me. It was not made so that you and I can prosper. All right, the U.S. Federal Reserve note was created for one purpose and one purpose only. And in my opinion, this is. And the purpose that the Federal Reserve note was created was to inflate the money supply such as that you and I will end up losing anywhere between 50 to 70% of the wealth that we acquired over our lifetimes. So if you and I are lucky, by the time that we die, all right, by the time that we leave this earth, we would have actually only enjoyed about 30% of the fruits of our labor. And then the other 70% or more was swiped away from us by a corrupt institution. Okay, so that's all I have for this video, ladies and gentlemen. I hope that you enjoyed this. If you did, please give it a thumbs up. And please share this information. This is important for people to understand. Even if I'm not 100% right in everything I say, I hope that you get the idea of where I'm coming from. All right, I'm trying to plant a seed in your head so that you can go out there and do your own research, and so that you can understand the system by which we live here. And not only in the U.S., this is pretty much all over the world, the way that this works. These numbers specifically, as far as mortgage foreclosures and stuff like that, is here in the U.S., but this is pretty much how it works everywhere else. All right, so, and like I said, if there's someone out there who's an expert, an actual expert, that they do this for a living, please let me know, and I would love to have you on so that you can explain to people in a more professional manner, I guess I could say, or in a manner by which maybe more people would understand than the way I'm putting it out. All right, but like I said, I hope you learned something. I'm going to be chatting with you guys here in a few minutes, but I'm going to go ahead and edit this video real quick and get it uploaded, so you're going to get another video today on Sunday. Having said that, ladies and gentlemen, thank you very much for joining me. Thank you very much for all of your support. It is truly appreciated. I hope that you guys are having a good weekend so far. All right. So remember to be good to each other. Remember that when good people do good things happen. Remember to reach one, teach one, and repeat. If we all did this, the world would be a better place. And you know that it will be a better place. Many blessings to all of you and your families. This is Alaska Prepper, and I'm out.